The US debt was just downgraded on Friday, May 16th after hours in a very surprise announcement by the credit ratings agency Moody's. Now, this comes at a very interesting time as the S&P 500 has rallied over 21% in the last month alone from the bottom that was established during the beginning of April. And we are now only 3% from all-time highs. It is also interesting that research done by Bank of America shows that this rally has been fueled mostly by retail traders. And in further research by Bank of America showing that hedge funds and institutions have actually been underweight and or net short securities that whole time. So what does this downgrade mean for the stock market? Why did it come now suspiciously? And what happened the last two times that this occurred? In 2023, we had a downgrade by Fitch, and in 2011, we had a downgrade by S&P. Let's get right into it. So Moody's downgrades US debt on Friday after hours. If you guys aren't familiar with credit rating agencies, how they grade US debt, and what this actually means, I'm going to break it down for you really quick in simple terms. So there are three main credit rating agencies. These aren't the only ones. There are other smaller ones, but nobody really pays attention to those. There's even one called Ding Dong or something. But Moody's, S&P, and Fitch, these are the three most important credit rating agencies in the world, not just for US credit, but for other sovereign debt in every other country as well. These are not government agencies. These are, in two of these cases, publicly traded companies, Moody's and S&P. Fitch is a privately held company, but they are not government organizations. Their credit rating system, meaning how they grade our treasuries or our debt, is slightly different across the board, but it's pretty similar. As you can see here, S&P and Fitch have the most similar credit rating system, and Moody's has a slightly different one. So instead of AAA+, they use AAA1. Very slight distinction. But in 2011, US debt was downgraded. We'll get into why in a second. US debt was downgraded from this AAA rating to this AA rating, and it hasn't gone back up ever since, meaning it hasn't been upgraded ever since. It stayed at that 2011 reading. In 2023, Fitch took it from that AAA rating to that AA rating and hasn't been back up since. Moody's was the last of the big three rating agencies with a AAA rating on US debt, and that was just taken down a notch to the AA rating on Friday, May 16th, as of the time of this recording. Now, why did they do this? In their statement, they said this one-notch downgrade on our 21-notch rating scale reflects the increase over more than a decade in government debt and interest payment ratios to levels that are significantly higher than similarly rated sovereigns. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. They also cited massive deficits and less demand for treasuries globally. Now, I promise we'll get into what this means exactly for the stock market, but let's break this down a bit further. So, the main concern is the rising debt to GDP ratio and the fact that successive administrations, so administration after administration, has done absolutely nothing to lower this. So there is a political element here, but not in the way that you think. As a matter of fact, the last two downgrades, the one from Fitch and the one from S&P, came during Democratic administrations, one during Sleepy Biden's administration and the other one during Obama's administration. This one during Trump's administration. If we take a look at those downgrades and you see the context of those downgrades, they all really hover around the debt to GDP ratio. So in 2011, the debt to GDP ratio was 70% of GDP was debt. It went to 118% in 2023, and now we are sitting at 124% of GDP. And we know that interest payments alone this year will likely cross the $1 trillion mark, meaning the interest that the US government has to pay for the treasuries that it has outstanding is going to cross the $1 trillion mark for the first time ever. And the US has the highest debt to GDP ratio out of all the high investment graded countries. And that just doesn't seem to be slowing down. Now, critics of this timing are stating that the bill, the tax bill that's not even ready to be voted on, that the details of the tax bill are not ironed out yet, and that the responsible thing for a credit rating agency to do is to wait to see whether this large tax bill, which will include stipulations on spending, how that is going to affect spending, how that's going to affect the issuance of treasuries, how that's going to affect the tax revenues that the government is going to get. Here's a little clip from Bloomberg describing what I'm talking about.
The timing is just very strange. Look, the bill is working itself through the Congress. We have to see what it looks like. The CBO's estimates of how they score, I have real problems with. For example, they're assuming GDP at less than 2%. I don't know what Moody's is assuming, but when you have 100% debt to GDP, as Secretary Bessent has mentioned, that is not unusual in the world we're in, especially coming after a period of very low rates. You had negative rates and zero rates through much of the industrialized world. So here you are, you're downgrading the country that has the reserve currency, you're downgrading the country that's growing the fastest of any industrialized countries, and you're also downgrading the country that has the best productivity per capita.
So I actually happen to agree with the sentiment that we want to see what's in that bill. Yes, tax cuts on their own will add to the $36 trillion in national debt. But we don't know what the spending cuts will be to offset those tax cuts. And we also don't have a good sense yet of what the tariff revenues will be for the next 10 years. Now, the timing is suspicious, and I kind of said this tongue in cheek on X. I said, institutions missed this entire rally. They're going to get their discount one way or another. So let's dive into how this will affect the stock market and how has it affected the stock market in the past. So on August 1st, 2023, that is when Fitch downgraded the US debt. At the time, we were just crawling out of a bear market that ended in October 2022. And the stock market hit a bull market in June of 2023, but we stopped just shy of the high in 2022. And then we had a 5% pullback and a small retracement, and then eventually the entire thing ended in a 10% correction that ended in October 2023 before then rallying 50% to the all-time highs that we saw in 2025. Now, 2011, when we got the downgrade by S&P, was a much different scenario. We were already in a downfall. This is because there was a major government standoff during 2011. We were already in a debt ceiling crisis, and the government was on the verge of shutting down. We were also recovering from the 2008 financial crisis, and we did hit a bull market coming out of the 2009 bottom. But nonetheless, what happened after the August 5th announcement of the downgrade by S&P, the market fell another almost 10%, so another almost correction since then. And after a rocky summer, the S&P 500 went on to, you guys know the story, one of the longest running bull markets in history. So now we're coming off of the 2025 all-time highs. We had the tariff panics take us almost to a bear market, over a 19% decline, not quite yet 20% on the S&P 500. NASDAQ did enter a bear market. And because of headline-driven optimism, basically reversing the entire tariff panic, we are now 3% away from all-time highs. The S&P 500 is knocking on that 6,000 psychological level, but we also have all of these gaps that are unresolved. So before I get into my stock market analysis and what I think will likely happen in the short term, it's important to note that we're talking about US debt, meaning we're talking about bonds here. And as we know, yields have been really stubborn. And if rising interest payments and rising debt to GDP is the main issue for the downgrade, stubborn yields are not going to help. And if this downgrade causes yields to spike, that is going to make the situation a little bit more precarious. So have the previous downgrades affected treasuries negatively, meaning have yields spiked due to the previous last two downgrades? If we take a look at 2011, treasury prices rose and yields actually fell. Now, the reason that was is because the world was still in terrible shape after the 2008 financial crisis, and US was seen as the safe haven. So the US wasn't the only one, the US's bond market wasn't the only one that was having jitters. The rest of the world was definitely a more scary place to invest at that time than the US. So we saw this flight to safety where people started buying US treasuries even more, and yields actually dropped because of it. Even though initially, after the August 5th, 2011 announcement, we saw a quick spike in yields, but then that dissipated. But remember, the Fed funds rate back in 2011 was basically zero. Now, in 2023, when we got the Fitch downgrade, the treasuries were basically unchanged. Now, the landscape was a bit different because the Fed funds rate was actually at the peak for this cycle, but we were in the short years after the post-pandemic where GDP was actually expanding and our GDP was healthy. We just got a negative GDP in Q1 of 2025. It's also important to note that in 2011 and in 2023, we had a debt ceiling standoff in both of this downgrade, something that is missing from the context of the 2025 downgrade. Now, with regards to yields, I think the situation here is way more complex than 2023 or 2011 because yields are stubborn. The White House is trying to bring yields down. And we don't know what the full effect of tariffs are. Even though we had that 90-day pause, which isn't really a 90-day pause, it's 90 days at the 35% tariff rate, which are still the highest tariffs since the 1940s. Walmart, whose profit margins are very low as is, already warned that they will have to raise prices. And the White House is now telling Walmart that they have to eat the tariffs. So if we start seeing this effect throughout the economy in the next few months, and either the corporations are going to make less money or the consumers are going to have to pay more for goods, both of those things can lead to a slowdown in the economy. And the Fed's number one reason for not lowering rates, even though inflation right now is near their target, especially if you start looking at the core or the super core inflation, until we know the extent of the tariffs, the Fed is not going to lower rates. And if the Fed doesn't lower rates, then the yields will likely be stubborn and may even rise a little bit. So in my opinion, there's still a lot of uncertainty in the bond market that could spur a recession down the line, depending on if we see the effects of the tariffs on the ground or not. Now, with regards to how this might affect the stock market. So if we take a look at a couple pieces of data here, and I sent this out in the Traveling Trader Trading and Investing Academy the other day, but I showed that, aside from the downgrade, the reason that we recently bought puts here is because if you look at the NASDAQ, after more than 24% of the stocks, so more than a quarter of the stocks are overbought on the RSI, these are the results typically a week to 2 weeks later. So a 5% drop on the SPY would take us to fill this gap. And honestly, I think that is a very plausible scenario here. The gap from April 22nd to 23rd would be about a 10% drop, which is typically what we saw the last two downgrades, even if the economic situation was a little bit different and we were facing debt ceilings in both of those cases. So in my opinion, down here 3% from all-time highs. Again, if we take a look at August 1st, we were 4% down from all-time highs from the 2022 highs. It would not be unprecedented to stop just short of all-time highs and see a pullback, at least a 5% pullback, if not a little bit more. And if you combine that with the data that we have here, which is the initial reason that I bought puts last week, we bought those on Thursday, you do have enough data to suggest a little pullback here, as well as technical areas where it would make sense to pull back to. I do also think that gold will rally off this, especially now that gold has pulled back into this major level at this fair value gap that you see here on the daily. And you could see if we pull up the Fibonacci and we measure just the extent of the last rally, we are now at the golden pocket of this pullback. So I do think that gold will likely see a rally as a safe haven based off of this. And if the market does pull back, I still think that is a buyable dip with this context. Remember, my thesis is that we will not get to these lows here, the 480 on the SPY, unless there is a material impact of the tariffs on the ground. Now, Walmart may be the canary in the coal mine. We're going to be hearing from the other monster retailer this week. Target reports earnings on Wednesday. But over the course of the next few months, if we start seeing that and bond yields continue to rally and the Fed continues to be stubborn because they're going to keep saying, we don't know what the effects of tariffs are, we don't even know what the tariff policy is, it continues to change, then I think the case for a recession is a lot higher, which is why JP Morgan and some of the likes have not taken the recession risk off the table. But make no mistake about it, we are seeing rabid buying now, and institutions that missed the entire rally, if we do get a pullback in the market, they will likely pile in. And the myriad of breadth thrust indicators, we've now seen 4 or 5 of them that haven't been triggered at the same time in years, where the results of those historically have been green 100% of the time 12 months later. I think the dips, if they are going to come from this, are absolutely viable. Now, in my opinion, I think that individual stocks here are better than the indices. As I said before, and I gave you guys the heads up time and time again, if you make a habit of buying the indices down every 10%, you will be golden. A lot of you did take advantage of that. Some of you didn't. So instead of buying the SPY or the QQQ, I personally would much rather buy stocks that currently have valuations that are less than the PE ratio of the S&P 500, which is around 21, 22 right now. There are still some mega cap stocks that are trading below that valuation. And of course, if the S&P 500 or the QQQ, if they start pulling back and start filling some of these older gaps here, and we are now down 10% again or more, then yes, in my opinion, those are levels that one should add to their long-term portfolio. Remember that policy can change anytime, and you shouldn't leave your portfolio in the hands of policy that can change on a dime. What happens if after 90 days, the Trump administration just completely abandons the tariff idea or gives another 90-day pause? What happens if the Trump administration and China actually come to a deal and that 35% tariff goes away and it becomes a 10% tariff? A recession risk is not off the table, but there's also a string of events that could eliminate or diminish the risk, right? If the Trump administration is conclusive about the tariffs, if the Fed now has a clear picture of what the effects are going to be, or if the tariff policy is forgiven altogether, mostly if we come to a deal with China and then the Fed says, you know what? All right, now this is good enough for us to cut, and yields finally start coming down, then yeah, I think that all of those breadth thrust indicators that show a higher market 12 months from now, that's actually going to be true. But because this video highlights the downgrade specifically, in summary, the downgrade in and of itself is not going to have a long-term effect on the stock market. The last two downgrades that we saw did have about a 10% effect on the stock market. But the economic environments that we were in a debt ceiling standoff both of those times. We are in a different kind of a standoff now between the White House and the Fed, and also within the White House itself, where they are trying to iron out the tax cut and spending bill. That could trigger a little bit of a pullback and a correction, which in my opinion would be a gift. Also remember that these credit rating agencies are just companies. They don't hold that much authority over our markets or our economy. Actually, in 2011, the Obama administration was very quick to remind S&P, hey, weren't you guys the same credit rating agency that rated mortgage-backed securities as investment grade? And in retaliation for downgrading U.S. debt, the government then threatened to open an investigation on S&P, and S&P forced their CEO to step down as sort of a consolation. I also find it weird that in 14 years, S&P has not revisited that downgrade. I do think that the growing national debt, the growing deficit, the growing debt to GDP ratio, the growing interest payments, I do think that is an issue. And I hope this last downgrade by the third and final credit rating agency of the big three lights a fire under the government's ass to stop the incessant spending and stop the crazy issuance of debt. Anyway, traders, I hope this helps you navigate all of the discussion surrounding the Moody's downgrade. I hope that I helped contextualize it for you guys as well. Look out for more specific videos on stocks and options to watch. If you want to trade live with me every single day, link is in the description below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.